All right, Alp, what do you think? Should we go ahead and get started here?
I think we're ready to go.
All right.
Good morning, and thank you for joining us today. This is Alp Adebeck, and I'm here today with Jason Dahl. Some of you may not know this about me, but my first career was as a CPA, and I focused entirely on preparing individual taxes. And I've said this in previous years when given this presentation, this is not the beginning of a comeback for me. I have no intention of entering the tax business again. When I look back at my life, the day I exited the tax business is possibly one of the happiest days of my life. Our title for today's presentation is Year-End Tax Planning Strategies. As always, we encourage you to ask questions throughout the presentation via the chat and Q&A functions that are at the bottom of the screen. So you can just, type it at any point, and Jason will pick it up. Jason or Natalie will pick it up, and we will try to answer it on the fly. Our agenda for today, so fairly straightforward. We'll go over some basics, different types of income, how they're taxed, deductions, credits, year-end tax strategies, and we'll touch a little bit on, I'll call it the Biden tax policies and what to expect there, but we're not going to spend too much time on that, and I'll tell you why in a little bit. We're all used to in this area of paying federal taxes and state taxes, because Maryland, DC, and Virginia, we've always paid taxes in those states, and generally at fairly good rates. But what most people don't realize, there are 7 states that do not have a state income tax, and it's probably picked up a decent amount of press with the new tax law. One of the issues with the new tax law was you're limited on how much you can write off on your state and local income taxes. They have this called SALT limitation. So the states that do not have a state income tax have become a lot more popular. And just this week, Elon Musk, the CEO of Tesla, it was announced and had been rumored for a while that he is moving. Actually, he has changed his residency, not moving. He changed his residency to Texas, and I would guess that he's made billions and billions of dollars on his Tesla stock, that he probably does not want to pay California their highest tax bracket on the state side, which is 13%, which is substantially higher than, Maryland's highest bracket is 9%, DC about 9%, and Virginia about 5.75%. But these states are gaining a lot in popularity. So, it's something to keep an eye on. And I will say this, that it actually becomes a problem for the states that have high state income taxes as people are leaving and also businesses are leaving. This week, it was rumored that Goldman Sachs is looking at relocating major portions of their business to either Florida or Texas. Again, 2 of the 7 states without state income taxes.
Alp, what were some of the numbers you saw recently from right out of Montgomery County, Maryland?
So I think in the first year of the Tax Cut and Jobs Act, so the 2018 year, in Montgomery County, Maryland, it was rumored that enough high-income, high-net-worth people had left the state that it actually blew a hole in the state income tax budget. I think basically, $40–50 million of revenue, and it's not just for 1 year, right? It's if they leave permanently, that's a lot of revenue over the future years, and that is a problem.
And most of those people were moving to South Dakota, right?
It's funny, out of our client base, I would say what we've seen happen in recent years is people that were spending 4 or 5 months in Florida, they had a second home there, they're now spending more than 6 months of the year and changing their residency. And that's for the retirees. We're now seeing it just for workers too. So different types of income. So we're all familiar with the term ordinary income, and that's taxed up to 37%. And what ordinary income is your wages, your interest income, dividend income, and I'll touch on that in the next slide. So that one has a little bit of an asterisk on it. Business income, Social Security income, retirement income, rental income, unemployment income. And so whatever bracket you're in, it could basically be taxed up to that bracket. So if you're in the 24% bracket, your ordinary income, a portion of it would be taxed at 24%. And we'll show you how that works a little bit later.
And there are so many things that have asterisks to them with taxes. Probably should have given that disclaimer right up front, that this is by no means meant to be an all-inclusive, tax advice for everybody. Always consult your tax planner, your financial advisor, so forth. Social Security income is just another one of those, right? It has an asterisk to it, to where, depending on what state you're in, is it taxable, even at the federal level. There's different levels of taxation to it. So just a few examples there of the mini asterisks.
And so two of the big ones, and this is something that it always gets a lot of popularity when Warren Buffett is talking about the inequality of the tax code, but qualified dividend income, which is generally almost all dividend income. So if you're getting dividends from Procter & Gamble, Chevron, Exxon, IBM, whatever it may be, that dividend income is going to be taxed at between 0 to 23.8%. And there's limits depending on how much money you make on what rate you'd actually pay there. Capital gains income can be either taxed as 15%, 20%, 23.8%. And if your income is below a certain level, it could actually be taxed lower, and for some people at 0%. And that's for long-term cap gains, and that's for assets that are held for more than a year. If you are trading stocks on a frequent basis, so if you're short-term trading at times, just holding things for minutes, those type of gains are taxed as ordinary income. So they'll be actually taxed at whatever bracket you're in.
Seeing a lot of that day trading activity again in recent times.
Absolutely. So this is just a great example of how the tax brackets work. And so we have the 7 different tax brackets that are in play right now. So for somebody that makes $200,000, they're going to have a portion of their income taxed in 5 different tax brackets. And I'm going to qualify my statement a little bit. I'll say if you have $200,000 of taxable income, so that's after you have itemized deductions or use the standard deduction. But in that example, basically the first $10,000 will be taxed at 10%, and the amount from $9,800 to $40,000 would be taxed at 12%, and so on. You would just go down through the brackets. So, if somebody's making $700,000 a year, they would go through all those brackets, but the amount of their income above $518,401, and this is for single filers, that would actually be taxed at 37%. And you can see the tax tables are different for married filing jointly. We're showing you the 2 most common ones. There's also head of household, qualifying widowers, but the brackets are fairly straightforward. And one of the things that actually changed in the Tax Cut and Jobs Act was they took away the so-called marriage penalty up through basically the 32% bracket. So it's something that was a big change, something people have been asking for a long time. And in the past, you could basically be penalized as a married couple just because the way the tax structure, or the tax tables were working.
Tax tables, yeah. And that's why, in every tax return on one of the pages, it'll sort of highlight for you what's your top marginal rate and then what was your average or blended rate. And that's what Alp was just explaining. I just want to pause for a moment. We had a bunch of people log in just in the last few minutes. So I just want to encourage folks to ask questions at any time. You can do that using the chat or the Q&A function that's on the toolbar. For most folks, that's at the bottom of your screen. Go type questions in at any point, and we'll definitely monitor those. Cool. Thanks, Al.
Okay, so what I talked about taxable income. So if you add up all your income, you then either take the standard deduction or you itemize your deduction. And what the standard deduction is basically a free deduction the government gives you. If you're a single person, let's say you have $200,000 of income and you don't itemize deductions, you don't get taxed on the full $200,000. You get taxed on $200,000 less the standard deduction. So, the $12,400 deduction, you would get taxed, if I can do math in my head really quick, on $187,600 in that example. And if you're married, basically you would get a $24,800 standard deduction. So, with the new tax law, the amount of people that now do the standard deduction has grown substantially. So if you are a homeowner with a either house that's paid off or a very, very low mortgage in today's low interest rate environment, you may not be itemizing anymore. It's interesting how many times we're talking with clients and they're telling us that, oh, we still itemize deductions, and then we ask them to send us their tax return, and we'll notice that, oh, they're not itemizing deductions anymore. It could be a married couple, and because the standard deduction is basically $25,000, the deductions don't add up to that amount.
Or even without looking at the tax return, I think Alp and I can tell quickly, just done so many of these to know, like, oh, well, you don't have a mortgage. We know what your charitable giving is, right? We can say, we don't think you're itemizing anymore.
And so if you don't take the standard deduction, if you itemize your deductions, the main itemized deductions are medical expenses, state and local taxes, which are now called the SALT deduction, mortgage interest expenses, investment interest expenses, charitable contributions, and miscellaneous itemized deductions. There are some other deductions, but these are the main ones that we see, and we very rarely see medical expenses, and I'll explain on the next slide.
Yeah, we're going to go into each of these in detail. So
for medical expenses, you can deduct medical expenses if you have unreimbursed medical expenses that exceed 7.5% of your adjusted gross income. And adjusted gross income is basically your total income before deduction. So if you've got, $100,000 of income, 7.5% of that number is 7,500. So your first 7,500 of unreimbursed medical expenses. And I like to say that is everything that affects your body or your mind except cosmetic surgery. So if you've got, insurance premiums, dental expenses, all that together and just co-pays, et cetera, all that together are your unreimbursed medical expenses. They have to exceed that 7.5% threshold. It's rare unless people have a lot of medical expenses. Pardon me, if they have a lot of dental expenses to be able to itemize with the medical expenses. I'll also say if somebody has a parent or if they themselves are in a assisted living facility and they're paying a lot of money out of pocket for that, that also usually throws people over that threshold.
And Alp, I'm not sure if were you going to talk now or a little bit later, sort of about the kind of some of the strategies in those instances where somebody may have, extraordinary kind of out-of-pocket medical expenses.
Well, since you brought it up, we'll go over it now. I was going to bring it up later, but for anybody that has either themselves or a parent in an assisted living facility, and if they happen to have a substantial amount of unreimbursed medical expenses, we've had scenarios where we've had a tax return that shows negative taxable income. So for example, if you looked at their Social Security income, required minimum distributions, investment income, all of that on their taxes, if they had $150,000 of medical expenses, we've had scenarios where people actually wipe out all of that income. And one of the strategies we look at in that situation is if you've got negative taxable income, it might make sense to accelerate the withdrawals from retirement accounts, or I'll say possibly do a Roth conversion. We'll go over that a little bit later, but there are some strategies to use. I know in my own family situation, my dad's no longer with me, but in the last few years of his life, he was in an assisted living facility and had substantial medical expenses, and so we were able to actually pull money out of his IRA account tax-free. So as opposed to when it went to the heirs, it would have been taxable to the heirs. So it was a pretty neat strategy. State and local taxes, this was basically the biggest change in the Tax Act of 2018. This is where your state income taxes, real estate taxes, personal property taxes, all of those together, you used to be able to write them all off when you itemized your deductions. Now it's actually capped at $10,000. And this is one of the reasons why you've seen a lot of people leave some of the high state income tax states. A major change, and this is something that a lot of people have tried to think of workarounds. And so if you're self-employed and you're using a flow-through entity, I'm not going to explain all of the workings of this, but I'm going to recommend that you actually talk to your accountants before the end of the year, because there might be a workaround on this for some self-employed individuals that is just starting to come out. I know it's out in Maryland right now, And there's a way you potentially can write off your state income taxes. Again, it's complicated to explain, but something to really look into. But again, this basically, if you have 40,000 of state income taxes withheld and 10,000 of real estate taxes, your deduction is $10,000. Mortgage interest, fairly straightforward under the new laws. You can deduct mortgage interest paid on up to $750,000 of mortgage debt for homes purchased after December 16th, 2017. So for example, if you sell a home and buy a new house in 2020 and your loan is $1 million, you can only write off the interest on basically 3/4 of that loan. So there's a formula you go through, a worksheet that will actually show you how you limit it. For homes purchased before 12/16/2017, you actually can write off up to $1 million of mortgage debt. Home equity lines now have to be used exclusively to have fixed up your home. So if you took out a home equity to be tax deductible, if you took out a home equity line and used it to pay for college expenses or just some pay personal bills, technically that is not deductible right now. I don't know exactly how they're really tracking that, but that also falls exactly into that 750 threshold too. So for example, if you have $600,000 on your mortgage loan on a house you just recently purchased, you can have up to a $150,000 home equity line that is used to improve your home and have that interest be tax deductible. Investment interest, that's basically when you borrow money to try to produce taxable income. So you could be borrowing money to, buy a business, buy land. And I would also say the most common one is if you have a personal portfolio and you've margined your account. And what that means is, let's just say somebody has a $500,000 portfolio and you are fully invested in the market, but you want to buy something else. You could actually put your account on margin, which basically means that you can borrow money on the account, and there's restrictions on how much you can borrow, of course, because there's collateral involved here. But the interest on that, if it's used to purchase investments, is tax deductible. So we see this frequently, and we've seen a little bit more of it in 2020 as the excitement around the big rally in the markets. You've seen some people get a little bit more aggressive with their money. So something to think about. I'm not recommending people take out a margin loan. We consider it a more aggressive move, but if you are doing it, just remember you can write it off.
But on some level, Alp, would you draw a parallel to the mortgage interest deduction here, right? Because the house is an investment, deducting the...
A little bit, but I guess the difference here is this is like used to produce taxable income. So in theory, like your mortgage interest, it all kind of goes in the exact same area on the tax return. But the difference being that the amount used to, produce, the amount borrowed to produce taxable income has always been considered tax deductible. And there's actually no limit on it other than the amount of investment interest you make. So for example, if somebody borrowed $1 million and paid, $60,000 in investment interest expense, you can write it off against your investment income. If you have more expense than income, it gets carried over to future years. So it's not lost. Charitable contributions, there's really been no changes here over the years. The main ones are things we pay out of pocket, cash, checks, credit card contributions, non-cash contributions, giving clothing, furniture, household items. And I don't know, Jason, if you want to talk about what you're hearing about what's happening on the non-cash these days.
Yeah, I'm sure many of you have experienced this yourself with, being in quarantine. A lot of the, in-kind contributions, so whether it be clothing, furniture, household items, those sorts of things, as folks are kind of spending a lot more time in their house organizing, cleaning out, a lot of the Salvation Armies, Goodwills have limited or even shut their doors because they've just been overwhelmed. As many of you may know, I serve on the board of directors of a local nonprofit called the Wider Circle. That is part of what they do, is they help families get their basic needs. And I know they are open and collecting items. So if you're looking to donate, some of your furniture, clothing, household items, I would consider a Wider Circle in this region.
And in addition to non-cash items, the clothing, furniture, things like that you're donating. And the way that works is you get to deduct the fair market value of those items. So at times we, back in my tax days, I would say people always overstated what clothing was worth. And possibly understated what things like furniture and various household items were worth, because some people give away some really nice stuff, expensive stuff. If they were to sell it, that would be in theory what the deduction would be worth. In addition, you can also donate appreciated securities, and there's some benefits for doing that. I'll go over that later. But what that means is if you own Apple stock and it's appreciated a lot, you can actually donate that to charities. The one thing to watch for, you want to make sure it's securities that you've held long term, 1 year or longer, and you get to deduct the fair market value of the contribution. But we'll get to that a little bit later.
One of the other items too that a lot of folks see advertised or do themselves, donating of cars, right? Old used cars. And this was several years back they changed it, because that was one kind of what Alp was talking about, where folks would overstate the value of their donated car. And the law now is you're allowed to donate, or you're allowed to deduct the amount that the charity ultimately receives for selling your car.
And that will be, they'll sell it wholesale. So, if you think the car is worth $5,000 and they just sell it wholesale for $3,000, that's your deduction, not the fair market value.
Yep.
Miscellaneous itemized deductions. So this was eliminated with the Tax Act of 2018, except for gambling losses, basically used to offset, taxable gambling income. But unreimbursed job expenses, all of those are out of your own pocket now. Educational expenses. So it's a big change, and that's actually going to be through the year 2025. If you have the opportunity to get reimbursed from employers for unreimbursed job expenses, this is a great time to try to ask what the policy is, or if you can kind of almost rework your compensation plan. If somebody has a lot of unreimbursed, education, business education related expenses, and I'll say just car miles, things like that, getting reimbursed versus getting, I'll call it bonus money or regular comp, you're better off getting reimbursed there, because that would be tax-free money.
Yep.
So when do you itemize? So basically, you add up all of your itemized deductions and you compare it to the standard deduction. So this is an example of somebody married filing jointly, and they've got that SALT deduction, their state and local taxes of $10,000. They have mortgage interest of $10,000, and in this example, charitable contributions of $2,500. Totals $22,500. As a married couple, their standard deduction is $24,800. So in this example, they would get a bigger deduction by taking the standard deduction versus itemizing. But I will throw this out. In some of the local states, and so we might have some people on the webinar here that are coming from other states that I just don't know the rules as well, but you might be in a situation, if you're really close to itemizing, there's a way at times you can force your itemized deductions, meaning that you would take a $23,500 deduction on your federal return versus the standard deduction. And the reason you would do that is a lot of the local states require you to itemize on your federal return if you want to itemize on your state return. And so it's one of those things that your accountant should be able to calculate what makes the most sense for you. So if you're really close to itemizing, there is at times a strategy here that could save you some dollars ultimately by not taking the standard deduction, but you have to run through the math.
And just to, another asterisk, just pointing out that the standard deduction for folks who are 65 or older or blind, there's actually an increased deduction amount.
So this next example is for a single filer. And so we've got $7,000 SALT deduction, $8,000 mortgage interest, charitable contributions of $1,500. That totals $16,500 versus the standard deduction of $12,400. So in this example, the person would itemize because they're now going to get an extra $4,100 of deductions.
And like in this case, with the new tax law from 2018, there was a lot of talk around, oh, am I going to lose the deductibility of my charitable giving, right? And so here's an example where in this case, they're getting the benefit of the deduction of the charitable giving, right? Whereas here, there is no value tax benefit from the charitable giving when it doesn't exceed the standard deduction level. So that was where there was a lot of articles and talk around, oh, are we losing our charitable deduction? And that it was sort of nuanced in this regard.
And I'll say in exchange for losing it, in theory, they just got a much larger standard deduction. But to
Exactly.
keep to refresh your memories, they also got rid of the personal exemption. So there's a little bit of trickery in giving you a larger standard deduction and no longer getting personal exemptions. There you go, common tax credit. So the difference between a credit and a deduction, a credit is a one-for-one reduction in your tax liability. So, after you've figured out your taxable income, if you have a tax liability before all the withholdings you've had or estimated payments, if your total tax liability is $23,000, if you have tax credits, they're a one-for-one reduction of that liability. And so these are the most common ones. And so today, I would say we see the adoption tax credit changing substantially, and that's usually a state-by-state basis too, so it's something to kind of look into. So I don't know if, Jason, you've had any clients recently that have adopted and have been
Yeah.
surprised given how big the deduction was.
Yeah. It was a significant increase on the adoption tax credit. Yep. We
And
have
we
had a
also
few.
we've have education credits on the bottom, lifetime learning credit, American Opportunity Tax Credit. So, these are things that you should just be aware of, that there's the potential for credits. We have an example on the next slide of the most common one. So this is basically the child tax credit. It's $2,000 for each qualifying child under age 16. The family tax credit is $500 for each qualifying dependent age 17 or older. One of the problems these days, this is something that the tax code's been using a lot in the last few decades, is there's phase outs. And so what that means is you can see it for a single person, head of household, married filing jointly, these particular credits will phase out above certain income levels, and they're completely eliminated for a single person at $240,000 of income. So they are probably in the DC area with a lot of couples earning above that amount. There aren't deductions that they're going to take advantage, or credit that's not a credit they're going to be able to take advantage of. But I know in the past, I remember doing some taxes for people that had I'll call it modest income and large families. And I think I calculated today that if somebody had 8 kids, they wouldn't pay any federal taxes on basically the first $150,000 of income. It's like an outrageous number with really generous tax
I
credits.
don't recommend that being your
Yeah.
sole motivation for having children, but
But it is
good to
fascinating,
know.
like the amount of credits, and it really was beneficial for larger families with incomes below these phase-out thresholds. Student loan tax deduction, again, it comes with phase outs, but you could possibly deduct up to $2,500 of the interest on your student loan payments. You get a full $2,500 deduction if you pay that much in interest. If you're single, files a single person, have less than $70,000 of income, and it's completely eliminated at $85,000. Again, the phase outs basically work on a straight line between $70,000 and $85,000, and you can see for the different filing statuses what the phase outs are. But fairly simple and straightforward tax deduction. And I'll kind of flash forward a little bit, stay on the slide, but under the, some people think that the Biden administration might actually do some type of proposal to eliminate a portion of the student loan debt that people have. So that'll be interesting.
Mhm.
Health savings accounts, fairly straightforward. Most people have them set up through their employers, and they've put through, payroll tax deductions. But one of the things that's interesting is you can actually also fund it before April 15th with your own additional contributions if you haven't maxed it out through your employer. So I don't know if, Jason, if you want to talk about like
Sure.
some of the
Yeah,
high deductible
I
plans.
was just going to mention we have a whole separate presentation just on this subject. It is one of our favorite subjects. I'll highlight that fourth bullet point there: triple tax free, right? In the context of taxes, health savings accounts really are probably the most friendly tool because you get that deduction for putting the money in. Any of the interest earned or growth is gross tax deferred, and when you pull the money out for qualified health expenses, they come out tax free. So if you want to learn more, we have recordings on the other presentation. Also happy to talk more, but I also just wanted to highlight what Alp mentioned. You have until April 15th to fund for the prior year, similar to IRA contributions. But keep in mind, those limits that you see there are a combination of both what your employer has contributed and what you contribute. So if you are fortunate enough to have an employer who contributes to your health savings account, you need to take that into account, that if they've put in, I'm just going to throw out $2,000 towards your family, then you personally can put in only $5,100 in that case.
And also you have to be in a high deductible health plan for the entire year to get to those limits. So if you were only in it for half a year, it'll be pro rata.
It's pro rata. Yep.
So retirement savings. So this is one that we wanted to spend a little bit of extra time on today, because as people have had extra income during the pandemic, just not spending as much money, excuse me, they might want to take advantage of making an IRA contribution, what we'll call a non-deductible IRA contribution. So if you're involved in an employer retirement plan and you're maxing out your 401k, most people think that you can't do IRA contributions anymore. You can always make IRA contributions. The question is whether they are tax deductible. So you could possibly make a non-deductible contribution to your IRA account. You track those contributions over the years. There's a form on the return, Form 8606, that tracks your non-deductible contributions you make in your lifetime. And then someday when you pull the money out, a portion, basically it's called what the basis of your contributions are. So let's say somebody has a $500,000 IRA account and they've put $50,000 in as an after-tax contribution. When they start pulling money out, in that example, 10% of it is a tax-free return of your own non-deductible contributions. Roth IRAs are also a very popular tool. You can see what the phase outs are there. The difference between a regular IRA and a Roth IRA is the money that you put in a Roth IRA that will grow completely tax-free for the rest of your life. So the amount you're allowed to put in is $6,000, $7,000 if you're 50 and over, but again, subject to phase outs. On the 401k side of the equation for 2020, you can put in $19,500. If you're 50 or older, you can put in $26,000. The Roth 401k, and this is combined. If you can put money in both the Roth 401k and a regular 401k, but the combined amount between the two that you're putting in is capped at whatever your age is. For a person age 50, plus they can put in $26,000 divided up between the two.
So I know a common question that we come across is, can you do both, right? Can you max out 401ks and IRAs?
You can max them both out, and we try to do that whenever there is, I'll call it excess liquidity in just the personal savings. And again, we've seen a little bit more of that this year, as people have said they just haven't been spending that much money during the pandemic.
So I know we're going to talk about Roth conversions in a moment. Alp, do you want to take this opportunity to talk about kind of the backdoor Roth contributions?
So one of the things you can do, and it can be, I'll say, a little bit complicated, but for somebody that doesn't have much money in a regular IRA account, or all their money is in their 401k, they can actually deposit money into a non-deductible IRA account, and the law then will allow them to convert it. This is called the backdoor Roth conversion, allow them to convert it into a Roth IRA. But there's that however there. If you've got I'll call it a material balance in your IRA account, there's a lot of tax consequences that are related to this move. So it's not as easy. So it's something that you need to talk to a tax advisor, or to us, obviously.
Yeah. And I'll say a balance in any IRA, right? It's not necessarily that particular IRA, right? The IRS looks at all your IRAs, and sort of, why would someone do the backdoor Roth conversion? Essentially, if you were subject to those phase outs, right? You say, hey, I want to fund my Roth, but I'm not eligible anymore because my income level phases me out. What's a potential strategy for getting money into the Roth?
So a Roth conversion is when you take a portion of your IRA account. You can do any amount or all of it and actually convert it to a Roth. And it is a taxable event. So for example, if you have a $100,000 IRA account and you're contemplating converting it, if you want to convert 30,000, the 30,000 you convert is taxable income for the year that you make the conversion, but then that money will grow inside the Roth totally tax-free for the rest of your life. This is a really interesting, I'll say, opportunity for anybody that has been, I'll say, affected by the pandemic, where they've lost maybe a high-paying job. They might be in a much lower tax bracket right now, so it might make sense for them to consider doing a Roth conversion. Other times when it's really beneficial to do a Roth conversion is, let's say there's a really big correction in the market. So, if the markets are down 30, 40%, and let's say they stay down at the, well, the recent one that we had this year that we dropped really rapidly, it just reversed out so quickly. Nobody really had the opportunity to do a Roth conversion. But if we stay at these low levels for a while, it's interesting. If you convert your money and then the account recovers as a Roth account, in theory, that entire recovery is totally tax-free, and the growth on it from that point is totally tax-free. So just really a great tool. It's also a great tool for people that have moved to states without state income taxes, and if they don't really need the money, it's one of those things that if they convert it and basically pay tax on it, but just federal tax, now someday when their heirs inherit the account, and if they live in states with state income taxes, they don't pay any tax on it. One of the negatives of making a Roth conversion for retirees, it could affect the amount of Medicare tax premiums you pay. Okay, Medicare insurance premiums.
Indian insurance premiums.
Yep.
Yeah. So there's a lot of variables to consider when thinking about a Roth conversion. So definitely something that worth consulting with us or your tax advisor, but kind of emphasizing what Al mentioned, that Roths, right, they grow totally tax-free for the rest of your life, but they're also, as he said, totally tax-free for the next generation, right? So Roth conversions are a great kind of multi-generational planning tool. I'll also mention Roth retirement accounts are not subject to the required minimum distributions. That's one of the other kind of added potential benefits for folks. If someone inherits a Roth, as an inherited Roth, they are subject to required minimum distributions. Well,
it's changed a little
slight
bit.
Twist on the rules this year. They are subject to being required to take the money out within 10 years, but it won't be taxed.
Without a doubt. And this is also a scenario where if somebody had a business that was greatly affected by the pandemic and they might have negative taxable income for the year, it's a great opportunity to do a Roth conversion.
Absolutely.
529 plans, basically college savings accounts. The three states locally, Maryland, DC, and Virginia. Maryland, I guess DC is not a state, but the three areas, they all offer tax deductions on your state tax return for contributions that go into 529 accounts. So this is one of the things that if you've got kids already in college and you're not taking advantage of this, I'll say it's a mistake. So for example, if you're paying $30,000 of tuition to a university and you're not using, and you live in one of these three states, and if you're not using a 529 plan, you're actually giving up what we call free money. You can essentially deposit the money in the 529 account, and typically they'll allow you to pull the money right back out. I'll call it within 5 to 10 days. It varies by plan. But by depositing it into the 529 account and then using the money to pay the college tuition, you can get a state income tax deduction, subject to limitations on each state, and there's carryover rules for that, but it really is just a simple way to take advantage of the tax law.
Yeah, we definitely see, if we take on a new relationship or have a conversation with somebody in college, that this gets overlooked, that simple little tip that Al just shared. Run the money through the 529 account.
We talked a little bit about this earlier, donating appreciated securities. And so the benefit of doing it is when you donate appreciated securities, you're not paying the capital gains tax. So, we gave the example of like Apple. So, if somebody's sitting on $50,000 of Apple and they want to make a $5,000 contribution to their alumni association or to a religious organization or to wherever, they can actually send $5,000 worth of shares to the organization. All the big charities and even the smaller ones now have it set up where it's very easy to do. Essentially, there's forms that are filled out, and we generally push the shares to the charity. And the benefit is you get the full $5,000 tax deduction, and you never had to pay tax on the money. And the difference is if you gave them a $5,000 check, that's after-tax money that you're giving them. In theory, by giving appreciated securities, you're giving them pre-tax money. And the charities, once they receive it, they basically sell it tax-free. So, and they generally will sell it almost immediately just to kind of diversify the portfolios.
Yeah, yeah, and most charities, as Al indicated, they will sell those, gifts of stock immediately, and that's in part because not only just to diversify, right, but because the gift typically is to be used for their programs, right, their projects, and so they sell it and then take the funds and utilize them for their work.
So even if you don't itemize deductions, you're better off donating appreciated securities. And if you liked the company that you gave away, so frequently we have people that are donating their Apple shares, but they still like owning Apple, you can actually just buy back the shares in your account and you establish a higher cost basis. So it's really just a great tool, and it's for securities that have been held 1 year or longer.
Yeah. I'll take this opportunity too to just mention, we have additional information, educational materials on donating appreciated securities and our next subject.
So donor advised funds, basically a tool that is being used now quite frequently. It's got a lot of press over the last 3 or 4 years. But a donor advised fund, probably the best way to think about the Bill and Melinda Gates Foundation, where they donate their greatly appreciated Microsoft stock, generally I'll say with 0 cost basis, into the world's largest foundation. So the example is they're getting a tax deduction for something that Bill and Melinda paid 0 for. So if they donate $1 billion into their massive foundation, they're getting a $1 billion tax deduction subject to limitations and carryovers, et cetera. But so you could actually donate appreciated securities or cash into a donor advised fund. You get a tax deduction for the year the donation is made. And you can make donations from the donor advised fund whenever you want. So you get the deduction in the year that it was made, but then you can actually leave the money in there for as long as you want, essentially. There might be some changes down the road. They've talked about some of these rules, but for now, basically, you can donate it. You can put the money into the DAF in 2020 and donate it out of the DAF in 2024. You do not get an additional deduction when you pay the money out of the donor advised fund, but this is a great option in today's new tax world, where basically the last item we have listed there, it's a great option for bundling contributions. So if you don't itemize right now because of this high standard deduction that they give you, this example here says, let's say you give $30,000 into your donor advised fund, and out of it, you basically make $10,000 contributions for the next 3 years, but you get that $30,000 contribution in the year 2020, and that will get you over the threshold for itemizing deductions. And so we've seen people use this that are retired, that no longer itemize and still are making charities a big part of their giving. So that's a big thing. And then also we have situations where if somebody is in a super high income tax bracket and they know when they retire will be in lower tax brackets, they will actually front load their deductions. So for example, if somebody's thinking of retiring in the year 2022 and they're currently in a high tax bracket, they might think of donating their charitable contributions for the next 10 years into the donor advised fund. Really simple, really straightforward.
One of the things that we always want to emphasize is we realize this presentation is focused on taxes, right? And donor advised funds and charitable giving and appreciated securities are tremendous tools for helping with lower tax liability and leverage your giving. But the key is, right, that there's always a charitable intent, right? That your plan is to give to charity even when you're in retirement, right? So we don't want to, sort of overemphasize all the tax benefits if there isn't already kind of a plan or intention that, yeah, I do want to continue to give to charity, right? You need to kind of have both the tax motivation and the charitable intent.
And probably it's a great time to say that when you've made that donation into the donor advised fund, that's a one-way gift. You can't pull the money back out.
Yep.
So keep that in mind. So in addition to excuse me, into using a donor advised fund, you can actually donate your required minimum distribution. So we don't have, RMDs for the year 2020, but let's say in the year 2021, if you wanted to donate a portion of your required minimum distribution, you can actually just donate it straight to the charity, and it's not taxable to you. So for example, if you give $3,000 to a church, that becomes money that you don't have to take out as an RMD, and essentially it's a way of kind of writing off your charity. The one thing to keep in mind is, let's say for example, your RMD in the year 2021 is $30,000 and you donate 10,000 of it directly to charities. The 1099 under current laws, the 1099 you're going to receive from the organization that holds your retirement account is going to show that you took $30,000 out. However, you need to tell your accountant, or if you're doing your return yourself, to only tax you on the portion that you actually took into your own hands. So if you donated $10,000 directly, you would only tax yourself on $20,000 in that example.
Yeah, if you recall on the 1040, right, there's the two lines. There's the, hey, how much came out of your retirement accounts, and then how much of it was taxable, and that's the key you want to apply. Also, just mention the strategy here too is if you sort of tie it back to the higher standard deductions, fewer people itemizing, but you say you still want to give to charity, but your charitable giving doesn't push you into the taking itemized deductions. Well, the QCD here, or the qualified charitable distribution, which is what Alp was just describing, is a great way to still get a tax benefit for your charitable giving. Just send that required minimum distribution. Thus, you're not going to be taxed on that money. So it can be a great tool if you're no longer itemizing.
So gifting, this is something that a lot of people hear about and they just don't really fully understand it. But essentially, you're allowed to give money out of your assets to anybody, generally considered an act of love. So it's, it could be friends, family members, whomever, but you can actually give up to $15,000 a year to anybody without filing a gift tax return. There's no tax deduction for you for doing it, and it's not taxable to the recipient. But the benefit of doing it is basically now that money is out of your estate, and they're subject to limitations depending on when you pass away in relation to when you've made gifts. But if somebody had a large net worth and they were trying to reduce that for what we call estate tax purposes, they could gift out to 10 different people $15,000 a year. If they're married, that could be $30,000 a year to each person. So really very powerful. Also, other ways you can actually take advantage of the tax laws. If you've got appreciated securities, let's say you've got kids that you're trying to give them money, and maybe you're going to liquidate some shares of something. If your kids are in a lower tax bracket than you are, you can actually gift them the appreciated securities, and the kids could then sell it in their tax bracket and avoid, I'll say, some of the I'll call it the higher capital gains taxes and the additional taxes. There's like I'll call it an Affordable Care Act tax that goes on when your income is above a certain level, an additional 3.8%. That may not be applicable to whomever you give the shares to when they sell it. So it can be a real simple way to take advantage of the tax law. But gifting is something that we've seen more and more of it, and we're also seeing it come up because right now the rules for how much you can pass to the next generation are really generous. And so some people are taking advantage of that by reducing their estates, passing gifts to the next generation. I don't know if you want to add anything to that, Jason?
Just you gave the teaser there. I'll just mention so what Alp means by generous is that under the current law, the federal estate tax, so the estate tax, for individuals, single people can pass a little over $11.5 million with no estate tax, and married couples it's portable, so between the two of you it's right around $23 million. So at least in Alp's definition, that's generous.
So we have seen people, because they're worried that threshold will be reduced in the future, they're trying to take advantage of it today. So for example, if somebody was worth $25 million and felt like they didn't need the money, that they've prepared enough for retirement, and they can actually gift some of that out to the kids. In that example, if they give a larger amount, so if they were to gift $2 million out to one person, they have to fill out a gift tax return. There's no tax owed on that, but it would actually track that you've used up some of your lifetime exemption.
Yep, yep. Alp, I'm going to jump in here just real quick. You mentioned a couple slides back that in 2020 there were no required minimum distributions. That's probably the biggest thing that's relevant here on the CARES Act that was passed earlier this year, kind of to what we're talking about. And I know we had a question that had come in on that piece of it. So Alp, let me make sure we address that question. I'm just going to get it here. How to take advantage of a one-time lower tax rate in a no RMD year. I know we've kind of touched on some of those, but you want to kind of revisit that?
Part of it is you just kind of run the numbers, and depending on how far you dropped in the brackets, if you've dropped substantially in the brackets by not taking RMDs, the question is, can you take advantage of, I'll call it the 12%, I'll call it the lower tax brackets, and up to whatever threshold you feel comfortable by doing something like a Roth conversion. So then once the money is in your Roth account, as we've already talked about, no more RMDs for that money, plus that money will grow totally tax-free for the future and will get passed to your heirs tax-free. So there are certain ways to take advantage of it. Some people, they may not take their full RMD, but they might just take a partial RMD, not really required. So for example, if your RMD was $80,000 and if you took the full 80, you would be at a high bracket. But if you just took 30 of it, you might be in a really low tax bracket and take advantage of that. So it's something that we really recommend reviewing.
And again, kind of to the multi-generational subject too, sometimes folks look at it and say, well, gosh, this is money that is likely maybe to pass to the next generation, and maybe the next generation is in their high earning years, and if when they inherit it would be subject to a higher tax bracket than the current generation. So maybe they go ahead and still take it because they just say, you know what, if they're sort of doing multi-generational tax planning, it may make sense to just pay it in the current bracket. A couple other just quick points on the CARES Act. There's a one-time charitable itemized deduction of $300 this year. So even if you don't itemize, if you're still just taking the standard deduction, if you gave at least $300 of cash or credit card, etc., kind of gifts to charity, you can still take a one-time $300 itemized deduction this year. So I want to make sure you don't miss that. I'm sure all the tax programs will prompt you to ask you on that, and some of the limitations or restrictions on how much you can give to charity relative to your AGI. Some of those have been removed. So just kind of under the CARES Act, there's been some incentives for folks to try to give more this year, given everything that's going on.
So some year-end tax strategy thoughts. We've got possibly 1 or 2 paychecks left for those that are still working. If you have not maxed out your 401k or 403b contributions for the year, and if you have the ability to kind of change it on the fly, so sometimes you can actually change it like a day in advance of when your paycheck's supposed to be sent, but something you have to double check, but you might be able to add additional money to your 401k or 403b if you've got the extra liquidity. Something that I always do is prepay my January mortgage payment. So, you have to pay it early enough to make sure it actually gets credited to the proper year. So for example, I'll send my January payment out pretty much in the middle of December to make sure that I get the deduction. And I'm laughing when I say this, but we've sent a few checks out of the office recently that honestly have taken like 2 or 3 weeks to get to their destination. I know we've kind of gone all through this with the election of like the mail being slow, but we've actually seen some examples of it. So my point being, if you're going to prepay your mortgage and if you're sending a physical check as opposed to doing it online, and some of the onlines will actually get it over there the very next day, just make sure you pay it in early enough. Roth conversions, if you want to convert in the year 2020 to take advantage of possibly that lower tax bracket, that has to be done by December 31st. And if you are considering that, make sure you talk to, also the custodian of your investments. If it's us, just on how much time we need before the end of the year to make sure that we can actually successfully do a Roth conversion. Charitable giving, if you want to take a deduction in the year 2020, those checks have to be sent by December 31st. Same thing with 529 contributions. If you are making contributions, they have to be in the hand of the 529 by December 31st, so make sure the timing is done properly there. On the subject of gifting, this is really important. They want to see the checks given and cash to prove that they were made in the year 2020. So for example, if somebody was doing, that $15,000 gift and they sent somebody a $15,000 check, if this ever were looked at, they want to see those checks cashed. It's not like I'll say etched in stone, but they're trying to avoid people kind of backdating checks and things like that. So we highly recommend getting the gifting out early and confirming that the checks have been cashed. Something that there's probably not that much of this year because the markets have rebounded so much. So if you're holding, I'll say, some energy stocks, you might have some tax losses. So if it's held in your personal account, it doesn't apply to anything held inside retirement accounts. But it's always good to kind of run through at the end of the year. So we do this automatically, and at times we're still holding on to some things that might be at a loss because we like the position. We don't want to sell it, but there might be opportunities. For example, if you've got Exxon at a loss and you want to stay in the energy sector, you can potentially sell your Exxon and buy something like Chevron and basically take your tax loss for selling the Exxon.
Be aware of the wash rules, right?
Yep. Yeah, if you're selling something and you really want to buy the position back, you actually have to wait 31 days before buying it back, or they will invalidate the loss, and that gets handled automatically by your custodian. So, if you sold something and bought it back in 15 days and it was a loss on it, they will automatically reverse it out for you, and you'll actually see it on your year-end 1099. Deductions by April of 2021 is just IRA and SEP IRA contributions. We have an asterisk next to the SEP because if you extend your tax return, you can potentially extend the time for donating into SEP IRA up till October 15th. And that would apply also for profit sharing contributions, KEO contributions if somebody's self-employed. HSA contributions in by April. Other tax strategy ideas, if you're having a high income year, and we know that there's been some businesses that have flourished in the pandemic and others that we know that have suffered. But if you're having a really high income year, you can potentially defer income into 2021. That's a strategy. But on the flip side of that is if you're having a really low year, we've talked about Roth conversions, but you might try to accelerate business income into 2020. Same thing applies to like deductions, where you can basically accelerate deductions, but that's kind of like giving the charitable contributions, business expenses, whatever it may be. If you have equipment that you need for your business, you buy it by the end of the year. Again, being mindful of what your tax bracket is and what your overall strategy is.
So Al, before we get into the Biden policies talk there, I just want to comment. We had a couple of other questions or comments. One around making these slides available. Yep, we are recording this. The whole slide deck and the recording will be made available most likely by tomorrow at the latest, or early next week. We will send an email out with all of that. And then had a question around kind of the CARES Act, but specifically the PPP loans, and will those, sort of the taxation of those out. Do you want to talk on that for a moment?
So I'll say the payroll protection program that was out earlier this year, where small businesses and actually some larger businesses were able to pick up a lot of assistance from the government. The original intent for that was that money would be totally tax-free to the businesses if the money was spent off of certain formulas in a certain amount of time. And so most people thought that this was going to be completely tax-free. It was Congress's intent to make it tax-free. And I'm going to say this is a fluid situation, but the IRS seems to think differently. And so the IRS says they believe it's going to be taxable in 2020 if you believe you've satisfied all of the requirements to have the loan forgiven. And so the IRS is actually looking at what I'll call just their old rules, forgiveness of debt. So the payroll protection program, that is actually considered a loan, that the intent was that it would be forgiven, but it would be forgiven in a tax-free manner. The IRS says their interpretation is it's not forgiven in a tax-free manner, and it will be taxable in the year that you satisfy all the requirements of it, meaning let's say you've spent it the way you're supposed to spend it. And if you've done that by December 31st, it's taxable in the year 2020. I'll say subject to amended returns in the future, where if they actually get some clarification on this, you'd basically be able to file an amended return in that example and make it hopefully not tax-free. Make it, pardon me, tax-free.
Make it tax-free, yeah.
Yep. So on the Biden tax policies, this is me as an old CPA, I would actually tell you, whenever there was a lot of proposals out, especially around election time, I typically tell people not to really worry about them until we actually see them turn into real law, because I think there's a lot of horse trading done. And unless that Biden gets the Senate by the Georgia Senate runoff that's happening on January 5th, I don't see that he's going to be able to change the tax laws that much. So a lot of his proposals were going against some of the very profitable big businesses and high income earners, people making over $400,000. He's made a promise that he was not going to hit anybody with higher taxes that makes less than $400,000. But I'm a believer that the odds are very low, unless he gets the Senate, that he'll be able to raise taxes. And even then, we think it'll be very difficult at a 50-50 vote. We realize the VP gets the deciding vote, but we think that it's going to be very difficult for him to make any kind of material changes to tax policy. So for now, we're not really that worried about it.
Certainly, at least for 2021, right? It would require
Correct.
a lot to have things come into effect in 2021.
And generally, they wouldn't even consider probably making any real proposals until we were completely out of the pandemic.
Exactly.
It makes no sense really trying to do anything to jeopardize the economy right now.
Yep. So good job. We are at 12 o'clock or 12:01. I'm just going to wrap it up here. So thanks again, everybody, for joining us. As I mentioned, we have a lot of other workshops, recordings, materials. You can check out a lot of those here via our website, /workshops. As I already said, this is being recorded. We'll make it available to everybody via an email that will come out in the next handful of days. If you have follow-up questions or would like to schedule a time just to chat and figure out if there's ways that we might be able to help you out, please reach out. Here, let me get to the next slide with our contact info and our great looking team there. And so hope everyone stays safe, be well, enjoy the holidays. Really appreciate you joining us today. And let me just double check, maybe we got one more question. Just a few
thank yous.
A few thank yous. Appreciate it very much. And without further ado, thanks a lot, everyone. Take care.
And stay safe. Take care. Bye-bye. Enjoy the holidays. Good job, Jason. Thank you.
Yeah, good job.